Good morning, everyone. Happy Tuesday. Welcome back to our Tuesday Mastermind. Today, we got the pleasure to talk to Equity Trust Company. We got John here and Christian, both representing their company, and they're going to tell us about the self-directed 401k product that their company has to offer. They've come highly recommended by agents within our office. Seth has used them previously. Sherry Anderson's getting involved with them. And Donna Fleetwood, one of our previous agents, has used them throughout the years. And again, they're highly recommended. And it's certainly interesting what they have to offer and how it can be beneficial to us as agents to be able to use this 401k money to invest in what we know, which is real estate, obviously. So with that being the case, John, I'm going to hand it over to you. If you could, start slow with us. This is probably the first time most of us are hearing about this. If you could give us a good overview on how it works and kind of tailor it to your real estate crowd here and how it pertains to real estate investment.
Absolutely. Thanks so much, Brooks, for the introduction and the opportunity on behalf of myself, Christian Cantu, who I understand leads the efforts in working with you and all of the other agents through the process of learning more about these opportunities and the self-directed accounts. Thanks for having us on, and we're excited to be able to share and educate folks and how they could potentially look at these various self-directed IRA instruments to invest in real estate. By way of introduction, I've been training investors for the last 15 years. I'm a real estate investor, mainly single-family rental properties and private money lending, but primarily in the single-family space. My background was in commercial real estate. Prior to that, studied traditional finance. And I'll say, like a lot of people that study traditional finance, I spent thousands of dollars learning about how to take IRA, 401k, and other retirement money and invest in mutual funds. So I was, and I like to say that I was brainwashed into thinking that the only way to save for retirement was to put money into an IRA or 401k or pension or other type of retirement plan. And all I can do is put it in the stock market. And then over time, balance it out with maybe some fixed income securities in order to weather the storm. Well, unfortunately, like we saw in 2022, not many people weathered the storm very well. And so 15 years ago, and this was during the Great Recession, I stumbled across Equity Trust, and I was involved in real estate at the time. And our company founder, Dick Desich, I met him and he became my mentor. And at that time, we had roughly 10 billion in assets under custody and administration, mainly in real estate. We now have over 40 billion in assets under custody and administration, just over 423 employees. So it's been an interesting journey over the last 15 years. And what I've spent my time doing is helping other investors, along with managing my own portfolio, helping other investors, including real estate agents, learn about how they could use IRAs, 401ks, and various other retirement plans to invest in real estate, whether it's single-family residential rentals, fix and flip, lease options, wholesaling, real estate options, investing in private money lending type opportunities, real estate partnerships. So if you're already actively investing in real estate, or you're looking to get started investing in real estate, or like a lot of real estate agents that I train, you may want to use this information and education to share with your investor clients and how they could potentially unlock their retirement plans, their IRAs and 401ks, and start investing in real estate. And I'm sure that some folks on today's call and maybe some of your clients are very much like me 15 years ago. I had no idea that I could use my retirement plan to buy a single family rental property and cash flow it and pay no taxes, and sell it and pay no long-term capital gains tax, not have to worry about recapture depreciation. So it was a massive aha moment for me 15 years ago. And so I've spent my years here trying to deliver that same aha moment to other folks. I do have some slides that I'll pull up just as some examples of transactions so you can see how this works. But I'd also like to keep this an open dialogue. So as folks have questions, feel free to use maybe the little hand gesture thing that they have on Zoom. Feel free to hit that button, and I'd be happy to, let you ask your question. I would prefer to have this more of an open dialogue than maybe a lecture for the next, 20, 25 minutes, however long Brooks would like me to speak for. So again, feel free to ask your questions. Quickly on Equity Trust, we are a directed IRA custodian, and that means that we don't provide any type of tax, legal, or financial advice. I certainly wouldn't be delivering any tax, legal, or financial advice on today's call. All right. So it sounds like everybody on today's call is not skeptical. I appreciate the introduction, Brooks, and the sort of endorsement in terms of using this strategy. So I'm sure everybody on today's call, you are convinced by now that you can buy real estate with an IRA. There's no question about that. But the truth of the matter is the rest of the country does not necessarily always think that. Don't be surprised if you're talking to a client about this strategy of using an IRA or 401k to invest in real estate. Don't be surprised if that client's financial advisor or financial planner roadblocks them into doing this. Does anyone know why a financial advisor or financial planner may not be open to their clients investing in real estate with retirement funds, with their IRAs, 401ks, other retirement plans?
They won't get paid?
That's right. They're not going to get paid. So when you go to a traditional financial advisor, and by the way, let me add a disclaimer. I'm not disparaging financial advisors or financial planners. I work with thousands of them. I think there's a lot of great ones out there. I'll also say, and I'll be very blunt and say that there's also a lot of really bad ones. And I get the opportunity and privilege to talk to a lot of those folks after they've created a disastrous of a mess for their client situation. So when they go to a financial advisor or financial planner, they're generally only able to sell them specific investment products. And I do emphasize sell them specific investment products. So, I always thought it was funny that we call financial advisors financial advisors. What if we called them financial salespersons? Because at the end of the day, that's what they're doing. They're selling an investment product. Yet we've always called them financial advisors. And for obvious reasons, right? Most people are probably not going to talk to their advisor or interact with their advisor or commit to working with their advisor if they're called a financial salesperson. So the industry found out a long time ago that we can't have this shroud of this person's a salesperson. We need to call them an advisor, because then people treat that person as an advisor, just like they might treat their attorney or their CPA or their doctor or other certified or accredited professional. And so it's important to understand that some folks might go to their financial advisor and they might be told that they can't do this, or it's illegal, or it's not diversification. That was always my favorite one. Well, investing in a single family rental property is not diversification. Well, last year in 2022, I sold a property. I made a 32% cash on cash return on investment, made a $35,000 profit, paid no taxes. Meanwhile, all of my family members were calling me and crying to me that they had lost 15 to 20% in their retirement portfolio. So in my mind, I look at diversification a little bit differently. And I think a lot of the folks that are in the real estate space, they certainly look at diversification a lot differently than maybe a traditional financial advisor or financial planner. And so needless to say, if you have anybody that's a little bit skeptical of using an IRA to invest in real estate, I always like to point people directly to the source. This is the IRS. So on the IRS website, you'll actually see where it says IRA trustees are permitted to impose additional restrictions on investments. For example, because of administrative burdens, many IRA trustees do not permit IRA owners to invest IRA funds in real estate. So this is where our firm comes into play. Equity Trust, we are a directed custodian that specializes in the custody and administration of non-stock market investments, including real estate, but you can also look at using an IRA to invest in private equity, venture capital funds, gold and silver, physical gold and silver, even digital currency like digital assets like cryptocurrency. Now, we're just going to stay focused on real estate here, real estate oriented class, but it's important to understand that you're really only limited by your own creativity in terms of what you can do with this self-directed IRA. But you have to be working with the right custodian. So your Fidelities, your Schwabs, your Merrills, your Morgan Stanleys, your TD Ameritrades, your Vanguards, those firms are not going to allow a customer to invest in real estate. Going back to what someone had mentioned before, those institutions don't make money if you hold real estate in an IRA. So why in the world would they want to hold that type of asset? They're not interested in holding that type of asset. They can't make money on it. They don't understand how to do it. If they do it, they don't know how to do it well. And so that's where our firm has stepped in. And we started back in 1974. And we created systems and programs and education along the way to specialize in these non-stock market-based investments. Could someone open an IRA with us and put their money into a mutual fund or stock? They actually could. We have the systems and platforms to be able to allow a customer to diversify into real estate along with traditional investments, but that's not our focus. And that's not what our customers' general focus is. Our customers' general focus is to diversify their retirement savings into real estate and other non-stock market-based investments. So you can go to the IRS website or direct someone to the IRS website if they're a little bit skeptical of this. Good news is, after today's session, if you are interested in more, call it marketing collateral or education collateral, you can go to our YouTube channel. We have almost 100 videos that we have done that we post on YouTube, free to the public, and you can take advantage of those. They're very educational. They're non-hypey videos. That it's not us driving around our Ferraris like you see on YouTube now, for people to get individuals' attention. We're a financial institution, so we're very educational based, very instructional based, and we want people to understand how this works and then make a decision on their own if they want to move forward with using an IRA, 401k, or their retirement plan to invest in real estate. So that being said, some important information just to understand from a foundational perspective. There are different types of accounts that you can utilize. And the two most popular accounts that you're going to hear of are a traditional IRA or Roth IRA. One account is tax deferred, and then one account is tax free, known as a Roth IRA. And most folks, they start with a 401k or maybe a traditional IRA or a Sep IRA or a simple IRA, and they transfer or roll over their money into a self-directed IRA. So the first step of the process for any investor is to open and fund their self-directed IRA. And that's where Christian comes into play. He can help you and your clients effectively go through the process of establishing and funding their self-directed retirement accounts. And for some folks, they might have like a 401k or a thrift savings plan or a 403b or a 457 plan. And so what we would do is we would help them open their account and then initiate a direct rollover from the existing account to the equity trust IRA. If they have an IRA, we would help them transfer from one IRA to the equity trust IRA. Now, really important to understand that there's no taxes or penalties to move money from point A to point B. One of the most common myths in the industry is that if I self-direct my IRA, there's going to be some sort of adverse tax consequences or penalties. And that's so far from the truth. All you're doing is you're moving the bank account, if you will, for your retirement plan from one financial institution to another financial institution. So from Fidelity to Equity Trust, or Schwab to Equity Trust, or TD Ameritrade to Equity Trust, or Vanguard to Equity Trust. So it's just a simple money movement from one account to another. And that's what Christian will do for you and your clients, is help you through that process, so you have the peace of mind knowing that you're doing things properly. If you are a self-employed individual, I assume most people, if not everybody on this call, is self-employed and has earned income. And so as a self-employed individual, you can look at one of these, I call them business retirement accounts. the Sep IRA, simple IRA, or solo 401k. And the reason why self-employed individuals will look at these small business retirement savings accounts is because you can potentially contribute considerably higher dollar amounts on an annual basis compared to just a traditional or Roth IRA. So with a traditional or Roth IRA for 2023, you can contribute up to $6,500 when you're under the age of 50. When you're 50 and over, you can contribute up to $7,500. But if you have a small business retirement plan, for example, a Sep IRA, if you're a higher income earner, you could potentially contribute upwards of $66,000 into a Sep IRA and get a $66,000 tax deduction. So we're talking about 9 to 10 times more in contribution mass compared to a traditional or Roth IRA. And then there's also what's called a solo 401k. And if you're interested in learning more about these business retirement plans, you can set up a call with Christian and he can send you some information, some video training, and actually talk you through these different plans. But for example, with a solo 401k, you can contribute potentially upwards of 66,000 as well. And if you're 50 and over, you could potentially get upwards of $73,500 into a solo 401k. And there's what's they call a Roth component, where you can put money in after tax. And that leads me to pre-tax versus post-tax. So with retirement plans, there are pre-tax accounts and then post-tax accounts. So with a pre-tax account, and when you hear pre-tax, think when you're putting money in, you're getting a tax deduction. It grows tax deferred. And then when you take the money out after 59 and a half, that's when you pay taxes. We like to use the analogy in the industry is you either pay taxes on the seed or you pay taxes on the crop. So with a traditional IRA, a pre-tax account, you're not paying taxes on the seed. So eventually you have to pay taxes on the crop when you distribute money after 59 and a half. A Roth IRA, you get the taxes out of the way in the seed, so you don't have to pay it on the crop. So for example, compare and contrast. Let's say you have a traditional IRA and you grow it to $1 million. And at 59 and a half, you take $100,000 out. Take 100,000 out. Let's say you pay a 20% tax. You're at a 20% effective tax rate. 20% of 100,000 is $20,000. So you don't get to keep the full 100,000. You got to give 20,000 to the IRS and then you keep 80,000. That's tax deferred. The benefit of a traditional IRA is all of your earnings in all of those years, as you grow the account, you don't pay any tax. But then when you start taking money out, that's when you pay tax. Roth IRAs, using the same example, let's say you grow a Roth IRA to $1 million and you take $100,000 out at 59 and a half, you pay 0% tax. So you save $20,000 in taxes in that example. For people that are in real estate, I find that they tend to lean heavily towards a Roth IRA. There is a school of thought out there that, well, John, why would I pay taxes on my retirement plan if I can get a deduction now and then offset, defer, and then when I retire, take money out when I'm at a lower tax basis? Well, that theory might work. It might work for some Americans, but what I find is a lot of investors, they like the Roth IRA because it's a hedge against future tax increases. If you're an investor that plans on never retiring from investing, which a lot of my clients are in that category, they anticipate still high tax rates during their years of retirement, then a Roth IRA might make sense. So if you're someone that's trying to hedge against your own individual tax situation, not going down, but rather going up, and if you're trying to hedge against the government raising taxes, a Roth IRA is a really powerful vehicle. And oh, by the way, with the Roth IRA, you can leave it to your children or potentially your grandchildren, and they would inherit the Roth IRA 100% tax-free. I used to ask at seminars, I'd say, anybody who thinks tax rates are going down, raise your hand. I'd get no hands. Who thinks they're staying the same? Get a few hands. How many people think that tax rates are going to increase? Everybody raises their hand. I'm not going to ask on this call here. I'm sure most people on this call are going to say that they believe tax rates are going to increase. So if you're in that category, if you feel that your tax situation is only going to increase, not decrease, the Roth IRA might be a good vehicle for you. A quick example of that. two clients that I started working with. Their names are Kevin and Cynthia. They're from St. Louis, Missouri. And I started working with them in 2010. And their words, not mine, they were stock market refugees. They lived through the Great Recession. Their 401ks took a 35 to 40% loss. They recovered some of their losses. And in 2010, they decided, we want to exit this and we want to start investing in real estate. So they rolled over their 401ks into traditional IRAs. That was the first step, is rolling their money from their 401ks into their traditional IRAs. They then converted those funds into a Roth IRA. So there's something that Christian can teach you more about called a Roth conversion. So you can take your tax deferred money and say, you know what, I think I'm going to grow this into a pretty incredible crop. And so I would rather pay taxes on the much smaller stock so I don't have to pay it on the much larger crop. And that's what Kevin and Cynthia did. They had about $200,000 in tax deferred monies. They converted those funds into Roth IRAs. They paid taxes on their $200,000 to the tune of about $70,000. So they paid a lot of money in taxes to do this. But over the last 11 to 12 years, they've grown their Roth IRAs to over $1 million in properties, and they're generating $130,000 in net tax-free cash flow on an annual basis. So every year, as they have $130,000 coming back in, they can take a distribution if they want to, because they're over 59 and a half, and they pay 0% tax. So if you're somebody that likes the concept of tax-free money, the Roth IRA would be a vehicle that you would want to take a look at. And know that if you don't have a Roth IRA now, there are ways that you can convert existing retirement money into a Roth. You can also make IRA contributions on an annual basis, and Christian can talk with you individually about how you can accomplish that. All right, so that being said, I'm going to run through some example case studies and then open it up for Q&A to get the wheels turning on, okay, how does this actually work? How do I buy real estate with a self-directed IRA? Well, there's a simple three-step process. And the first step is opening and funding the account. The second step is directing your investment. And then the third step is managing and harvesting your returns. So for anyone who's taking notes out there, again, that was open and fund your account, step one. Step two, direct your funds. Step three, manage and harvest your returns. So let me give you a real basic single family rental property example to start. Gary from Ohio, he bought this property at a foreclosure auction for $68,000. And his IRA, his Roth IRA, took title to the property. So when you're filling out a purchase agreement, whether for your IRA or a client's IRA, instead of it being in your name or an LLC name, it's going to be in the name of the Equity Trust IRA. So the vesting you'll see here is Equity Trust Company, Custodian, FBO, Gary's IRA. By the way, some folks like to be anonymous. They like to keep their name off public record. So instead of titling the property in their name, they'll title it Equity Trust Company, Custodian, FBO, their account number, IRA. In this case, Gary did title it in his name personally, didn't have to, but that's what he chose to do. He bought the property for $68,000. IRA paid cash for the property. Now, can an IRA borrow money? IRA could borrow money. I'll try to mention that in a little bit here. But in most instances, you'll find IRAs generally are acquiring properties as cash buyers, or the IRA account owner is partnering with other money sources. And I'll show you some examples of that in just a minute. So Gary bought this house for $68,000. He put $20,000 worth of work into the property. So really important to understand that when your IRA buys a property, your IRA has to pay for all of the fix-up, repairs, carrying costs, everything. Because it's not you that owns the property, it's your IRA. So your IRA is responsible for paying for all of those expenses. This was $20,000 in this case, so he was in it for about $88,000 with his Roth IRA funds. He's renting it still to this day for $950 on Unit A and $900 on Unit B. So this is an up and down two-family. He has $1,850 in gross rent coming in on a monthly basis. His monthly net operating income is $1,400. There's no debt on the property, so we have no debt servicing. That $1,400 is tax-free in his Roth IRA. The current value of this property is $140,000. This is right outside of Cleveland, Ohio, in a city called Maple Heights. $140,000. So he's got, after closing costs, if he sold this property, we could call it about $40,000 in capital gains. If he were to sell this property today, he would have 0% tax on his capital gains. No recapture depreciation, no long-term capital gains tax. With IRA transactions, you don't lose depreciation. I get that question all the time. John, I was watching this YouTube video with a guy driving around a Ferrari, and he tells everybody not to buy real estate with an IRA because you lose depreciation. Well, number one, I'm not sure that that's the most credible source coming from someone that's driving around a Ferrari in a YouTube video. But number two, by the way, some of these jokes aren't that great. I spend a lot of time in the tax code in 4975, section 408. So if I tell a dry joke, just laugh at me at some point. All right, but back to my story here. A lot of people might say, well, it doesn't make sense to own real estate in IRA because of depreciation. Depreciation offsets taxable gains, taxable income, and then eventually it gets recaptured. With an IRA, there is no taxable income. Your IRA is tax exempt. So there's no taxable income to offset. And of course, the IRS isn't going to allow you to double dip. They're not going to allow you to depreciate a property on your own Schedule E or your own tax return when it's in your IRA. So you want to think of it as two totally separate businesses. Treat your IRA as a totally separate business from you personally, totally separate tax return. In fact, the good news is an IRA doesn't have a tax return. So Gary, in this example, he doesn't have to report that $1,400 on any type of tax return. It goes directly into a self-directed IRA. It's tax-free in his Roth. If he sells the property, he pays no taxes. If he leaves it, if he passes away and leaves it to his spouse, or him and his spouse both pass away, he leaves it to his children, grandchildren, they're going to inherit that Roth IRA 100% tax-free. In fact, I mentioned Kevin and Cynthia before. I'm getting a little bit ahead of my skis here, but I'll mention this because it could be very important for some folks out there. So Kevin and Cynthia, they have over $1 million in properties, and they're generating $130,000 in tax-free cash flow on an annual basis. And when I asked them, what do they plan on doing with the money? They passionately stated that they're not going to use any of that Roth IRA money themselves. They plan on leaving it to their children, or if their children have children, they'll leave it to their grandchildren. Because under the Roth IRA rules, under IRA rules in general, IRAs avoid probate. And if you structure it right, your IRA is left to your children or grandchildren. In a Roth IRA environment, 0% tax. So there's that estate and legacy planning component to the Roth IRA that can be really powerful. All right, next example. And I put this in here because it demonstrates how you can aggregate multiple money sources. So one of the common concerns that I get from investors, and you'll most likely get as well from some folks from time to time, is I don't have enough money in a retirement plan. The hard truth here is Americans have not saved enough for retirement. And I don't want to get into our retirement plan crisis episode that we do, but I'll just give you a brief snippet. Americans between 55 and 64 years of age only have approximately $104,000 saved for retirement. 41% of Americans have $0 saved in retirement. 50% of Americans have little to no savings in retirement. Unfortunately, we have not done a good job as a society of teaching folks about retirement savings accounts. That's something that I've been doing for the last 15 years very passionately. And I'm not afraid to speak very bluntly about the American retirement plan savings crisis. Because if somebody doesn't talk about it the way that we know it needs to be talked about, nobody's ever going to make a change. People are just going to continue to go on and not contribute to their IRAs, and then one day wake up and say, gosh, I wish I would have contributed to my IRAs over the last 15 years. I would have had all this tax-free money, and I would have been able to go out and invest in real estate and not have to pay taxes. So that's my public service announcement with respect to retirement savings. Back to the program here. This example is where I partnered my Roth IRA with my traditional account, and I put some non-IRA money into the deal. So in this example, you're actually seeing where you can partner multiple money sources that you have together. Now, you will find that you have to be careful in how you structure this. If you're going to partner with yourself, or you're going to partner with your spouse, or you're going to partner with a child or a parent or grandparent or grandchild. So there's certain family members that are considered disqualified persons under the provisions of 4975 of the tax code. And if you want to transact with one of these disqualified persons, you have to make sure you structure it properly. So you're going to see in this example where when I bought the property, I split the profits and expenses proportionate to my capital contribution. So let's run through this. I bought this property. It's a 2-family property right outside of Cleveland, Ohio, in a city called Maple Heights for $63,000 in March of 2020. And I bought it from a motivated landlord. This landlord was not doing a good job taking care of the deferred maintenance. They also weren't doing a good job taking care of the tenants. I had 2 tenants that I inherited when I bought the property. Our intent was to buy, stabilize the property, cash flow, and either hold it as a long-term rental, or if we can make a decent profit, we'll sell the property and then move on to another transaction. That's what we ended up doing. We partnered on the deal. My self-directed Roth at 55%, my traditional at 35%, and then personally, I put in 10% for the deal. At the time of purchasing the property, I didn't have enough money in my Roth IRA. So that's why I partnered on the transaction in this fashion. So when it was all said and done, all of our cash flow and all of our expenses were split up 55, 35, and 10%. It has to be done that way. So if I'm partnering on a transaction like this, again, got to make sure that all my profits and all my expenses flow proportionate to this capital contribution of 55, 35, and 10. We sold the property May of 2022 for $115,000. After closing costs, our cash on cash return was 32%. Our profit back into our traditional and Roth was $35,000. Had we had to pay long-term capital gains tax, we would have had to pay about $5,000 in taxes. But because it was in our self-directed Roth and traditional, we are exempt from long-term capital gains tax. So we saved $5,000 in taxes. Now, the 10% that went back to us personally, we're going to have to pay capital gains tax on that. So when we file our return here shortly, we're going to have to pay the capital gains tax on that 10%. So this was a great investment. I was very pleased with the outcome. I was able to take this $35,000 in profit plus my principal and actually put it into a private money loan that I made to a real estate investor 10 days after we closed on this property. So the way that we keep our money moving, my wife and I, in our self-directed accounts, is in addition to owning real estate, we also are private money lenders. So we loan money secured by real estate to other investors. So if you're somebody that wants to take a little bit more passive approach, or maybe you have clients that want to be a little bit more passive, they can also be private money lenders on real estate transactions. Here's one regret that I have on this transaction. And let me just throw it out there to open up some dialogue here. Does anybody have an idea of what I could have done on this deal to make it completely tax-free? And the hint is this 10% equity that I have with me personally, my taxable income. I mentioned I am married. My wife does have self-directed retirement accounts as well. I could have partnered with my wife's retirement plan. And that's my one regret on this transaction, is that I didn't bring in my wife's retirement plan as the 10% partner, because then I wouldn't have had to worry about paying taxes on 10% of the gains. I can partner with my spouse's IRA. I can make private money loans and partner with my spouse's IRA. A good example of a husband and wife partnership. I had husband and wife, John and Teresa. They're from Indianapolis, Indiana. And John's actually a real estate agent. He's been a real estate agent for about 25 years. Brooks, this is you're with Remax, right? Everybody on the calls with Remax. Is
Yes.
that correct? Okay, great. So this client, John, by the way, he was a Remax agent. So he bought a property for, it was about $80,000, and he partnered his IRA, his Roth IRA, with his wife's Roth IRA. And John's Roth IRA had 82% interest, and his wife's Roth IRA had 18% interest. So it was an 82%, 18% split. They bought the property, they rented it out for 3 years, and then they had the opportunity to sell the property to actually the state of Indiana, because the land needed to be used for a major road project that they were working on. So they sold the property for about $210,000. Over the course of 3.5 years after the sale, they made approximately $146,000, and that was all tax-free. So their Roth IRAs split the $146,000 in profit. 18% went back to John's Roth, and 82% went back to his wife Teresa's Roth IRA. Again, that was all tax-free, no capital gains tax, no recapture depreciation, so on and so forth. All right, my last case study, and then we'll just open it up for questions. Scott and Kate. So I've been talking a little bit about partnering with family members, which are known as disqualified persons. But what happens if you partner with a non-disqualified person? So if you put together a real estate joint venture, let's call it a fix and flip type transaction, with a non-disqualified person, you could really negotiate whatever profits you want. And this introduces the concept of growing a small balance IRA. So I get this question all the time teaching at different seminars and conferences across the country. Well, John, I don't have a lot of money in an IRA, and the whole concept of partnering an IRA with other IRA funds, that doesn't really work for me. But I'm an investor and I can find deals. I can find good opportunities. So how can I make this work for me? Well, a real estate joint venture can be a good mechanism to do this. So here's how it worked. Scott and Kate, they are not related to one another. They're two investor friends, and they met each other at a real estate investor association meeting. So I'm sure you're familiar with some of these, different RIA meetings and MasterMind groups and things like that. So they were part of one of these groups. And the problem that they both had, Scott's problem, was that he had a $24,000 Roth IRA, but he needed anywhere between $250,000 to $300,000 to do the types of deals that he wanted to do. So he didn't have enough money in his Roth IRA to invest in the types of properties that he was investing in. And Kate, her problem was she had about $200,000 between her Roth IRA and her health savings account with Equity Trust that was sitting on the sidelines, earning little to no interest. So you can imagine there's a lot of people out there right now that are sitting on dry powder because they're afraid of the market. They don't know where to put their money, and they have everything tied up in short-term, low interest-bearing investments. And they're looking for a better return because of inflation eroding at their principal on an annual basis. And Kate was exactly the same way. So Scott had a property opportunity, and he brought in his $24,000. He bought the property, partnering his $24,000 Roth with Kate's Roth IRA and HSA at about $200,000. They had a simple 4 to 5 page real estate joint venture. And per this real estate joint venture, when they sell the property, 70% of the profits are to go back to Scott's Roth, and 30% of the profits are to go back to Kate's Roth and HSA. So a 70-30 split. So this property was sold. They made a $60,000 profit. Scott's Roth IRA made $42,000 tax-free. So he grew his Roth IRA from $24,000 to about $66,000. And then Kate's Roth and HSA made about $18,000. So Kate's Roth and HSA made about an 18% annualized return. It was about a 6-month transaction. And Scott's Roth IRA grew from $24,000 to over $66,000. Had another transaction, this closed 2 weeks ago. Two clients, Doug and Ron are their names. They're from Dayton, Ohio. And Doug only had about $13,000 and some change in his Roth IRA. And him and his investor partner, Ron, who with his IRA, they bought a property together. So Ron's IRA funded a majority of the transaction. Doug's Roth IRA only funded about $13,000 and some change. It was about an $80,000 purchase and rehab deal. They sold the property, and Doug's Roth IRA received a majority of the profits. So he negotiated a much larger percentage of the profits, just like Scott did here. And 2 weeks ago, he had a wire transfer come back into his Roth IRA in the amount of $47,000 and some change. So he grew his Roth IRA from $13,000 and some change to over $47,000 and some change, tax-free, no short-term capital gains tax. It was about a $34,000 tax-free profit in his Roth IRA. So those are a couple examples of some shorter term, smaller dollar investments that you could potentially consider with your self-directed IRA. I mentioned private money lending. These are just a couple pictures of some private money loans that I've done with my self-directed IRAs over time. This was actually the first transaction that I ever did, going back 15 years ago. Wanted to get involved in real estate, didn't know exactly how to do it. And so what did I do? I found an investor that was flipping houses, and I made a $23,000 private money loan, charged 12% interest, made a $2,000 profit. That's what sort of got me hooked on private money lending. And I started finding other borrowers and making loans to other investors. There's another loan example, series of loans that I've done here over time. All of the profit on private money loans is tax exempt in my self-directed accounts. So I'm not paying any interest income tax on those transactions. And then lastly, a little bit about equity trust. Christian, he can talk to you a little bit more about equity trust, who we are, what we do, just some quick factoids about us. We've been doing this since 1974. We have over 40 billion in assets under custody and administration. We are regulated as a trust company, and our primary regulator is the South Dakota Division of Banking. You can also check us out online. We were rated by Investopedia in 2020 to 2022 as the best overall self-directed IRA custodian. So this is what we do exclusively. We help investors utilize self-directed IRAs to invest in real estate. This would be a good time to just open it up for some Q&A or any comments that anyone has. If you are interested in learning more or having a discussion, Christian will be available and at your disposal. So there's his email address if you wanted to email him. And Christian, it might not be a bad idea if you can post something in the comments box. Maybe post your Calendly link. If anybody wants to just schedule an appointment using your Calendly link, that might be a good option as well. But let me stop there. I know I probably gave you more information than maybe Brooks was expecting. I do tend to give a lot of information and education in our seminars and conferences. So if it was like drinking through a fire hose, please forgive me for that. But I prefer to give more education than less education. But I'm happy to stick on here for as long as necessary, or Brooks would like me to answer any questions that anyone might have.
Thank you, John. It was a great presentation. Definitely a lot of information. Does anybody have any questions here at this point that they want to ask John or Christian? I see Christian just posted his Calendly link there. If you want to set an appointment with him, feel free to reach out. Poppy, Uncle Tim, any questions? Any comments?
Basically, it's a pretty interesting concept that you're doing, especially it sounds to me, and I'm just listening to what you had to say, that it's almost that you have a move up step with the first couple of IRAs into the Roth and the other one, so that you can roll the money over that you have saved to go to the Roth. Is that correct?
Yeah, I think that's a good way to look at it. If you have tax deferred money, you can step yourself into a Roth IRA, whether through a conversion or start making contributions. It's not one or the other. Plenty of folks have traditional IRA money and Roth IRA money. And I do. I have traditional and Roth IRA money. And a lot of folks, you'll find they have 401ks from companies that they work for, 403bs, 457 deferred compensation plans, which are for police officers and firefighters and other municipality government workers, other types of retirement savings accounts. And most retirement savings accounts in the United States are all tax deferred. So people were getting deductions. So the natural progression is to roll that money over into a traditional IRA. And then from there, they can grow the account tax deferred. But if you wanted to get into a Roth IRA environment, that's where you would convert those funds from the traditional to the Roth.
So as a hard money lender, what's your percentage of take back when you put that money out there?
Me as a private money lender, I am charging at this moment in time, I'm charging 12 to 13% per annum. Obviously, it depends on the transaction, depends on the borrower. The borrowers that I work with now are all borrowers that I've worked with for a number of years now. And so, there's a relationship and a rapport that we have there, but that's generally the rates that we're charging. That said,
I understand the rate. I'm asking, in your experience on the way up, because we're all newbies in this thing that you propose, what was your take back rate on or risk involved in loaning that money out in the beginning?
Oh, I'm sorry. So as in default.
Correct.
I was fortunate. I've never had a default. I've never had a default. I have had loans that have reached maturity, and we had to do loan modifications, make other arrangements. But fortunately, I've never had to foreclose, take back a property through foreclosure or deed in lieu of foreclosure.
Okay. And the other thing that I thought was quite unusual is person putting up, and one of the examples was $200,000, only received 30% of the profits, and the other, the finder of the property got 70. Obviously, that has to be a very big negotiated point in the deal. Is that correct?
That's correct. So there was a joint venture agreement that was drafted by their attorney and spelled out which percentage went to which parties and the responsibilities of both parties. So there was that joint venture agreement. But yeah, that's a good point. He was able to negotiate that transaction, and I suppose he was able to do that because the investor partner, who was the passive money investor, she was making little to no interest with the money sitting in a cash account. And so making a 9% return, 18% annualized, I suppose was attractive to her. We're not involved in the negotiation of those transactions. That's just between the investors.
And lastly, and I have to ask this because we're in the business also, we have a property management division. We would say, how do we get on your recommended list of property managers?
So that's a good point. So property management is important. And with an IRA, there's a way to manage properties on your own. So as long as you're not providing services, you can't do sweat equity. But there are plenty of investors that are interested in just hiring a property management company. We do have we call it our exclusive benefits portal within our My Equity system. So we could certainly have a follow-up conversation with respect to, if you are running a property management company as well, how you can gain some exposure to folks that might want to utilize those services.
Love
So
to
that'd be a
do
good
that.
follow-up for us.
That's all I have, Brooks.
Alrighty, guys. Well, if no one else has any more questions, we'll wrap this up. Thank you again, John, Christian. Thank you for your time. This was an awesome presentation. I think this stuff is very important for us as realtors. You know, it's a way to invest, as we say, in what you know, and gain some tax benefits and stuff along the way. So this is a great time to learn up on all this information. And, you know, if we ever have a down time in prices, you'll be ready and prepared to buy in that instance. So thank you guys again. Any questions, reach out to me. I'll direct you guys to Christian and John, and look forward to chatting more about this in the future.
Very informative. Thank you.
Thank you.
Awesome.
Nice to
Thanks,
meet
everyone.
everybody. Thanks.
All right, guys, have a great week.